Hello my friends, Magnus here, and this one is for definition of terms and introduction into topic of casino affiliate programs audit. So many of you may have this file that I have spread. This is a template for doing audits. So basically it features two scenarios, one called product 1 and other is product 2. So it's done for better understanding of how things may work and for you to calculate the possible options. So the file also has controls, so you may input your own cost of acquisition, meaning this is prepayment, CPAs that you use, your own ref share, everything you have, also your cost fixed and so on. Now let's get to explanation of making definition of key terms, what I mean by them, and this is this is what prepare you to the seminar itself. So actually the whole idea is appropriation of unit economy to the business domain of online casino affiliate marketing. Unit economy is something that builds a revenue and all the stuff to the per unit level. So here in our case, unit, the basic unit is FTD or player. What we mean by price in the general case is LTV or lifetime value of a player. Now let's stop on LTV for a while. So LTV, we use LTV amount, which is essential, and as I was saying, this is the same as unit price in a unit economy. So if you start out and you don't have the data, you may use dummy data, as I suggest. Is for example, 750 euros lifetime value per tier 1 player and maybe 300 euros per tier 2 player on average. If you have your own data, you may fill in. If you don't know what to take, you may just take your revenue and divide by your number of players. Okay, lifespan. So LTV will be broken down to 4 quarters. This is the whole lifespan of a player in my calculation. So this is something that's based on practice. If in reality this estimation is conservative or low, the LTV of the following period will rise. This is obvious. So I will capitalize a rise in LTV once a year in the quarter 4 for the ease of calculation. So LTV change, if you look at the table, you will see there's that LTV change. As I was saying, the change may come from capitalization of the conservative estimate, and also it rises with time, like naturally, is a function of greater brand awareness and liaison with publisher and so on. So it's obvious also, just to give it a note. If you work on your relations with publishers, it will rise more drastically. So now about cost fix. Cost fix is calculated on per unit basis. Example of calculation of cost fix I put down in my article, how to do online casino marketing. I will put a link here. For the theory, you may see Investopedia, unit cost, and so on. So basically, what I mean by unit cost is rent, your payment by amortization of software that you use, and also your salaries and so on. So this is something that doesn't change depending on how many units you produce. So then the marketing costs that are variable in nature. So I include here cost of acquisition that consists from prepayment and CPA, and also the marketing costs that are revenue share. So prepayment is calculated on a per unit basis. This is something what you call publisher entry fee or equivalent. The CPA is obviously something that you pay if you have a hybrid deal, CPA plus revenue share. So revenue share itself is, I take 30% of GGR vis-a-vis GGR. This is roughly 40% in GR if you take admin cost of 25%. You may have your own data as well. So the total variable cost is as a prepayment plus CPA plus revenue share vis-a-vis GGR. So much for revenue build. Coming down to income statement. So it has revenue, it has fixed cost, variable cost, gross profit, and SG&A. So revenue is calculated as the number of units, FTDs, by LTV of the quarter. As LTV of players are accrued, revenue rises by quarter, which is evident in quarter 4. These data are capitalized. Variable costs are accrued to are incurred to obtain an FTD, which is obvious, just to give you an additional note. So gross profit is revenue minus cost, fixed and variable. SGA, this is selling, general and administrative expenses. Basically, these are cost of doing business. So here I will include platform fee. If you use, as you do, white label or turnkey casino platforms, plus your selling expenses as a majority to give a percentage of sales to the team. Now, EBITDA is clear as gross profit minus SG&A. Well, the key ratios. So key ratios is something that's probably the most interesting part here. So we use unit gross and processing gross. This is basically clear from the table. This is gross by quarter, capitalized in the quarter 4. ROAS, or return on ad spend. This is revenue divided by variable costs, and its significance is that it shows the effectiveness on your spending on each player acquisition. Gross margin or gross profit margin. This is a percentage of revenue that exceeds the cost of making goods. This is cost fixed and cost variables. So the higher gross profit margin indicates that the company is overall successful producing profits above its cost. So basically, the gross profit margin is something that's significant when you want to talk about efficiency of your management overall. LTV by CAC, LTV divided by cost of acquisition, is something that compares the value of a customer over the lifetime to the cost of acquiring, and it has to be, obviously it has to be more than 1, in which case the company simply destroys value. So the closer it comes to 3, the better is it. So a unit contribution margin is represents the portion of sales that isn't used up by variable costs and can be contributed to covering the company's fixed cost. So it provides the way to see, well, the potential of each particular unit, and it shows the portion of sales that helps to cover the company's fixed costs. And finally, the EBITDA margin is EBITDA by revenue divided by revenue. It tells you, any analyst in and about how much operating cash is generated by each euro of revenue, used as in comparison most of the time. So actually, this is a quite short definition of terms that I use. You actually know them by heart, but in case you just want to know, I get them also. I have this file I can show. So let's probably come to the discussion of this situation, because it has raised lots of questions on the LinkedIn, and so I guess I need to clarify things up. So now that you have this table, you may want to listen to the legend. The legend is that there are 2 products or services that are basically related to 2 most popular affiliate strategies. First is attracting a large amount of FTDs at relatively high marketing costs with low growth and near flat margins on the maturity stage. The second one is a low quantity actually is twice as low. Lower marketing spend, but higher growth and higher pricing power. Well, revenue build is something that uses real numbers or numbers that are close to real. You can, as I was saying, you can manipulate it by yourself. And what we see from it is that product one has a average LTV of per quarter of 186. Product 2, 208. So it's not that significant difference, but they all start from the same level, 170 euros. Whereas in the first product, the pricing growth is capitalizing quarter 4. In the second option, in the second product, this is something that changes quarterly. You may do otherwise. This is just a way to add some twist on the table. Well, for the purpose of discussion, the rise of LTV, this is what is generally called pricing growth, is a function of time in both products. So it rises naturally, is a measure of effectiveness of the affiliate marketing team, brand awareness, liaison making, relation building, and also research and development. So, as I was saying, each product uses cost fixed and cost variable. The model itself uses 6 quarters. So coming down to the discussion, we may see that product 2 attracts 400 FTDs per quarter, and this number rises to 450 from quarter 4. So actually this is 3.7% rise per quarter. Product 1 does the double, so it has 800 FTDs with the same pace of unit growth, with the same dynamics. So if you look at product 2 cost fixed, it's 275,000 euros versus 400,000 in the product 1. So this is the difference of 125,000 yearly, or a little more than 10,000 euro monthly, is by the legend attributable to the fact that the product 2 has lower quantity of FTDs, and it actually may want a lower size of affiliate marketing team, probably only 2 affiliate managers. It doesn't want a liner management, no affiliate team lead, no nothing. But the product 2, which is more demanding one, high growth potential, has a 2% higher of SGA. So they have platform and selling expenses a little higher, which is a success fee paid to the team. So as I was saying, both products start from 170 per quarter LTV. This is 680 euros annualized. So by our convention, the full players LTV realized by 1 year or 4 quarters, and likewise the first option has analyzed LTV of 700, whereas the product 2 has analyzed LTV of player of 778, which is 11% of difference. Okay, so cost fixed per unit of FTDs are lower with product 1, which recruits twice as many players as product 2. These are 100, as you can see, these are 118 versus 162 euro per unit. Average revenue share per unit is GGR 30%, in 2 cases. And product 1 uses higher marketing costs. These are 80 euros per player, whereas the product 2 has only 30 euros per player. This is, by legend, is only prepayment, no CPA. Okay, so it's clear that a lower cost of acquisition with product 2 is responsible for probably lower quantity, whereas maybe responsible for a higher effectiveness of partnership building, as lots of time are left to build partnership to work on laser making. And this in turn brings a higher LTV. So the pricing growth for the product 2 is almost twice as the product 1. So this is 6.6 per quarter on average versus 3.5 per quarter with product 1. So the return on ad spend is more significant in product 2. It starts from €2 per €1 invested in ads and goes all the way to almost €3, which is quite solid result. Overall, despite the fact that the cost fixed per unit with product 2 are significantly higher, this is 37% higher, the product 2 gross profit margin really looks better due to a higher unit contribution margin, which is 63% versus 50% on average. So talking about break-even, the product 1 business break-even time is in the end, you can see it from the table, is in the end of 12 months of operation, whereas product 2 break-even point is in the end of 10 months of operation. So normally we calculate break-even as a fixed cost divided by gross profit margin. And what is not evident but can easily be calculated is that product 1 needs investment to start over the business of about €740,000, whereas the product 2 is almost twice as low. So it's €370,000 to start over the business. So what's interesting is that product 1 has a flat margin starting from quarter 4 onwards, and it's attributable to the fact that LTV of the portfolio of the players is realized to the fullest by this time, and it doesn't actually grow any longer. It shows a limit of growth of margins, and it even points to the direction of a decrease of these numbers unless affiliate marketing team finds a way to lower cost of acquisition or increase LTV. So this is actually a pivotal point where a shift in marketing strategy shall take place. This is actually starting from quarter 4 and onwards. This is a point when you shall be scaling up or finding a way to lower your cost of acquisitions or increase LTV. With the product 2, we can see a much better dynamic. Actually, the product 2, the company has probably at least 2 more quarters than shown on the table ahead of the situation of the competitor. So it means they have more time to choose the next move. Either it can be attracting high LTV players that will allow in numbers, but to a lower cost of acquisition and becoming a niche, unlike casino brand, or for example, attracting more players at a higher marketing cost, but trying to retain LTV. This is what we call scale up, or otherwise making other strategic moves. Probably coming to the strategic moves after quarter 6. This can be a topic of another seminar. What strategic options are open to each team, and what are they comparative strengths. So this is a short discussion of what you can gather from this table. You may, as I was saying, manipulate it. You can use your own data, calculate your growth potential and your options. The fact that we have 2 products is easy for you to see that you can actually compare your probable options. You can use both as a meaning of your of your portfolio. So part of your portfolio will be product 1 and part will be product 2. Thank you anyway. I welcome you to give your questions here. Please do comment and ask your questions. I'm happy to answer them in online seminar, not to go over it again, but to engage in real discussion with you. Thank you. Bye.